Good afternoon, everyone, and welcome to FEI Dallas's webinar today entitled Bankruptcy, How to Avoid It, Benefit from It, and How to Fund It. Before we begin, I'd like to review a couple of housekeeping notes regarding our CPE credit offerings today. We are offering 1.5 CPE credits for today's presentation. To be eligible for the CPE credits, you must answer at least 5 of the 6 polling questions during the webinar and have a total viewing time of at least 75 minutes. Participants will have the opportunity to download their, that's not correct. Participants will receive an email letting them know that their CPE credits will be available, and that will usually take between 7 and 10 business days. In accordance with the standards for the National Registry of CPE Sponsors, CPE credit will be granted based on a 50-minute hour. We are unable to grant CPE credit in cases where technical difficulty preclude eligibility. CPE program sponsor guidelines prohibit us from issuing credit to those not verified by the technology to have satisfied the minimum requirements as listed above. We do recommend, if you do not answer the polling questions in the platform, that you answer in the Q&A just to be sure that you can get the CPE, and we will take a look at those at the end of the program to make sure you're eligible. And now I'd like to turn the program over to Ron Rushing. Ron is CFO of ProStar Energy Services and also the FEI Dallas chapter president. Welcome, Ron.
Thank you. I want to welcome all of you to today's program. It's being presented by our good friends at Harrison Dickey. Kelly Harris and Helen Dickey became sponsors of FEI back in 2012. Have been important parts of our chapter ever since. Harrison Dickey, which was founded in 2010, is a boutique certified women-owned management consulting and recruiting firm, is focused on assisting the CFO and CIO suites. They're an agile firm that responds to client needs with speed, experience, and efficiency, and provide better and more cost-efficient solutions. They provide customized services in accounting, finance, internal audit, technology risk, project management, and not surprisingly, bankruptcy. John Tittle joined the firm in February and leads the accounting practice with a focus on bankruptcy and restructuring. Now let me introduce Kelly Harris. Kelly holds a BBA in accounting from Texas Women's University. She's a founding partner of the firm and a CPA with over 30 years of corporate and consulting experience. She was previously also a founder and market leader in the successful Deloitte spinoff, RGP, that went public in 2000 and grew to a multinational professional services firm. Take it from here, Kelly.
Thank you, Ron. I think we have a CPE question. Is that right, Nancy?
Here's your first polling question, audience. Do you have prior experience with bankruptcy? Please don't hesitate to take a few moments to consider those answers, yes or no, and please press submit, and we will give you those answers in just a moment. I guess that was an easy one. I think we'll end that poll right now and share those results. Okay, and those are the results.
Thank you, FEI members and guests, and our panelists today for joining us. We are pleased to present this distinguished panel. I believe you will find them knowledgeable, engaging, and very informative. Our first panelist is the Honorable Judge Jernigan. Judge Jernigan was appointed to the U.S. Bankruptcy Court for the Northern District of Texas in 2006. Prior to her appointment, she was with Haynes & Boone in the business reorganizations and bankruptcy practice for 17 years. Not only is she distinguished in law, she is also an author, including a fiction legal thriller titled, He Watches All My Past. It is available on Amazon and at Barnes & Noble, and if you feel like it, let's support the judge. Judge Jernigan received her JD from the University of Texas Law School and her BBA from SMU, graduating magna cum laude. Our second panelist today, John Penn, is a partner with the law firm Perkins Coie, when he leads the bankruptcy and restructuring practice. John has been involved in bankruptcy and restructuring for over 35 years. He is licensed to practice in Texas and New York. John completed his 6th marathon this year, including an ultra marathon which is over 31 miles. He also earned his Eagle Scout status at age 13, and he graduated from law school within 4.5 years, which is quite an amazing feat. John holds a JD and BBA from Baylor University. Ross Gatlin, our next panelist, is CEO and managing partner of Profit Equity, a private equity firm that specializes in investing in distressed assets. With his knowledge, expertise, and investment strategy, he has created over $2.4 billion of value during his career. Very impressive. Ross holds an MBA from Kellogg School of Management, where he received several distinguished honors, and he earned his BBA at the University of Texas in Austin. Last but not least, our own John Tittle. John is the managing director of the accounting and finance practice at Harris & Dickey and heads our bankruptcy and restructuring practice. John has over 30 years of bankruptcy, restructuring, and financial consulting experience. John had his own business, a financial advisory restructuring boutique firm, for 9 years, and he was the lead partner at Deloitte over restructuring in the Mid-America region. John is not only a CPA, he holds 5 other distinguished certifications some that relate specifically to restructuring. John received his BBA in accounting from Texas Christian University, graduating magna cum laude. I believe it's time for another polling question.
Thank you, Kelly. The second polling question is up on your screen. Has your prior experience with bankruptcy been as a debitor, lender, unsecured creditor, buyer, or none of the above? Those are quite a few choices to make. So if you've got a few seconds, don't forget to hit submit. I'll give you just a few more seconds. Okay, I'm going to end that poll and share those results. It seems 24% are debitors, 7% are lenders, 13% are unsecured creditors, 1% a buyer, and a lot of none of the above.
Okay. John Penn, our first question today is, we are aware that business bankruptcies are on the uptick. What, in your opinion, is in the first wave?
So far, what we've seen that, especially locally, is a big upswing in energy cases, and that goes throughout the whole spectrum of everything dealing with energy, whether it is the E&P folks, the drillers, the servicers, everyone else. In fact, we haven't had a $1 billion debt energy case filed in Texas since yesterday. Arena Energy was the most recent one that filed in the Southern District of Texas in Houston yesterday. As we go forward and take a look at the general types of cases that we have, moving on, you'll also see that there are restaurants and retail that are really taking off, and not surprisingly with things being closed down. The travel and hospitality, hospitality being a lot of the hotels, it's, nobody's traveling. And you're going to see those that will be accelerating in cases going forward. And the healthcare cases are somewhat surprising to some, but when you take a lot of the profitable matters, the surgeries, the elective surgeries out of the system, and that just creates all kinds of cash flow interruptions that are going to create problems. So far, Kelly, it's been an interesting 2020.
Yes, it has. John, I'm going to come back to you on this one. Beyond the obvious causes of the pandemic and a global oil glut, were there other factors that contributed to the issues faced by the industries or companies?
Absolutely, and it was underway even before the pandemic, because as we see moving forward, the second quarter year-over-year case filings have actually increased dramatically, and you can expect that to turn into a hockey stick kind of a graph as we go forward. The other thing that you'll see as we move forward is that the range of defaults are increasing. If you see the yellow areas, that's where the recessions have been. When there's been an uptick, you usually see the recession that follows closely behind. And while we're not at the heights yet of the 2001 or the Great Recession, things are definitely moving forward in that direction. And I would be remiss if I didn't note that Ross and his firm are the ones that created these slides for us. I did want to thank him for putting these together. This is not my work, I just get to present it. Continuing on, you'll see that the average debt multiples are increasing. This actually reflects of middle market loans, and the middle market in this chart refers to EBITDA of less than $50 million. And what you can see is in 2007, right before the Great Recession, it was at 5.6. Then when people got a little smart, a little conservative, it dropped down in 2009. And of course, history repeats itself because we never learn our lesson on the first go round. And if it weren't for that, where would we be? Another issue that you find is the financing terms with first lien loans that have only one covenant. And this chart shows that the 26% with the bottom of the arrow is actually 2007 on this chart. And it shows that there has been a dramatic increase in one covenant loans and the amount and the dollars percentages outstanding in one covenant loans. The issue with one covenant loans, quite frankly, is there goes your early warning system. The covenants are there to warn lenders and borrowers that there are issues, there's problems, there's a mountain ahead that you're flying into. And if you take that early warning away, well, a lot of times you're finding that we've had a number of bond issuances where they have actually filed Chapter 11 before the first coupon was due. That is something that happened more than once in this current cycle. And it is really fairly interesting to watch that happen, but you see the trend and the trend is only increasing. Ross, is that the kind of stuff that you're seeing as we go through?
Yes, it's pretty interesting right now. Unfortunately, as you mentioned, we seem to have an issue with human nature repeating itself in these types of situations. And so the one thing we can count on is a similar wave as we've seen in prior situations like this. And as those default rates climb and you have the largest amount of leveraged loans ever outstanding in the United States of America, it's going to lead to, as you mentioned, more than just $1 billion of defaults, unfortunately, probably in excess of $100 billion or more of restructuring situations that need to be resolved.
And that leads us to the final slide that Ross prepared for us. And it shows how we have not learned our lesson, because this chart shows the amount of outstanding leveraged loans. It is proof that those who do not study history are doomed to repeat it, because you can see where in 2007, 2008, there were 500 to 600 million. We learned a little bit, and then we got aggressive and the leverage took off. It's now almost double what it was. The first outstanding leverage loans is what it was back before the Great Recession. And when it comes to leverage, anyone that has ever been on a playground teeter-totter should really understand leverage, because leverage works both ways. It can accelerate earnings and it can accelerate losses. We're about to experience that in spades. Kelly, one of the questions had sort of been as to whether this was foreseeable or not. In the bankruptcy world for the last 5 years, we've been saying that the next wave is coming, and it's always been 18 months out. What these slides show is that what we have really experienced is the prairie grasslands getting drier and drier, the underbrush in the forest accumulating more and more. We expected there to be a lightning strike that would start a fire. The pandemic has not been a lightning strike. It's been a napalm attack. It has covered a broad swath and lit entire sections and various zones, various industries completely on fire. And it's going to run for a while, unfortunately.
Thanks, John. Judge Jernigan, we have seen the headlines and heard from John Penn just now about the proliferation of bankruptcy cases since COVID-19, which is not at all surprising. Can you elaborate on what specifically is happening in Texas? Are the bankruptcy courts busy?
Well, Kelly, yes, we are much busier these days. To elaborate a bit on what John Penn said earlier, we have a PowerPoint slide that lets folks see a large listing of companies that have filed Chapter 11 in Texas, all over Texas, just during the months since COVID-19 hit. And I should add, this is not even close to being every business case. What I have done here is simply included either what I considered mega bankruptcy cases, and I define mega bankruptcy cases as involving $100 million of debt or more, as well as a handful of other cases that are not quite that big, but you may have heard of them. This is all public information, by the way. As you can see, we have a great number of energy sector companies, and it's inclusive of E&P companies, oil field and offshore service vendors, midstream companies. This list, by the way, is 2 weeks old. As John noted, you know, we've had more billion-dollar companies file in the last few days. And I would elaborate on what John Penn said, that these companies were already on the precipice, I would say, because of the commodity prices being so low and supply being so high recently. So when the demand plummeted after COVID-19, there was absolutely no cushion at all for many of these companies. A lot of these cases are pending in Houston, where they are actually based, although we have a few here in DFW as well. And I would say this is partly because the deep water offshore drillers are hurting the most because of offshore drilling being more expensive than, say, shale drilling. The slide also shows several big retail companies, including JCPenney, Neiman Marcus, Tuesday Morning, several restaurants, and Gold's Gym. I've listed one case that I thought was especially unusual, RE Palm Springs. That's a half-constructed luxury hotel in Palm Springs, California. And I'm guessing it's not the only half-constructed building out there that is in a bind on getting completed because of economic troubles, especially in the travel industry. And then we have a number of healthcare companies that have filed Chapter 11, and I suspect with little doubt that's only the tip of the iceberg. I'm going to elaborate a little bit in a moment about healthcare bankruptcies, but I'll highlight one of these recent ones, Endologix and Trivascular. This is a mega company that is a manufacturer of stents for the aorta. And it's an international company. with several $100 million of annual revenue. And as John Penn alluded to with healthcare companies, COVID has impacted it because not only did the company have to shut down a massive manufacturing facility in California, but many times a medical procedure to place a stent in someone is considered elective, non-essential. You know, it doesn't have to happen tomorrow. It's just something you really need to take care of. So when hospitals nearly everywhere restricted or prohibited non-essential medical procedures due to the COVID risks, that affected not only this company I've highlighted, but you know, because its stents were not being used so much, but we know there has been an effect on all kinds of medical facilities and doctors, et cetera, because of this cutback on non-essential services, which tend to be the profit areas for these medical facilities. Further elaborating on the healthcare, I put an interesting factoid on the PowerPoint under 2E there. We have had more large healthcare Chapter 11 bankruptcies in recent years, and this is going back 5 or so years, than any other district in the country, Northern District of Texas. And I'm talking about, in addition to hospitals and doctors and dental chains, senior care living facilities, nursing homes, those freestanding ERs or urgent care facilities that you tend to see in so many shopping centers these days, in cancer treatment centers, you name it. I would add that a lot of these are not locally based. There are California-based companies, East Coast-based companies that have chosen the venue of Texas for their bankruptcy filings, which is interesting to me. Kelly, did you want me to go on from there, or?
No, Judge, let me ask you another question. What do the recent bankruptcy cases in Texas tell us about our state, or what insight can be gained from the number of healthcare cases filed in the Northern District of Texas?
All right, well, with regard to our state, let me just say this. Historically, big corporate Chapter 11 cases tend most often to be filed in the Delaware or Southern District of New York bankruptcy courts. There has long been a perception that the courts there are corporate friendly, if you will, that the folks up there have a wealth of experience with corporate restructuring. But I would say the tide has turned somewhat on that. We have professionals here, I'm happy to say, who have a wealth of experience with restructurings, and our bench, if I may say so, is pretty deep with bankruptcy judges who have decades of business bankruptcy experience as judges and attorneys. Many of us also have accounting degrees. So I'd like to think, you know, maybe this uptick in filings in Texas, the venue shopped ones, might mean people have confidence in our professionals and our benches here. I should also add, we have gotten very adept at doing video courts. We started in immediately at the end of March, having video hearings, and I think a lot of places now are starting to do that, but you know, we made it very clear, you know, you can get an emergency hearing here, even in spite of COVID. We will allow video participation when people, you know, don't feel comfortable coming to the courthouse. With regard to your healthcare follow-up question, I guess I'll just emphasize that there is absolutely a confluence of factors that have contributed and will continue to contribute to so many healthcare filings. First, factor I would mention is that these are very capital intensive businesses. They continually need the newer state-of-the-art stuff, and so that's obviously expensive. Second, many of these are regulated entities, and there are obviously so many expenses and delays associated with having to deal with the regulatory authorities, the HHSC, the Health and Human Services, HUD, and the regulators, frankly, change the rules a lot, and that makes business difficult. Also, I would add that if Medicare and Medicaid are sources of revenue for a healthcare provider, they are notoriously slow paying and low paying. So, even the private payer insurance pay can be very slow paying. So if a healthcare business happens to have a big portion of its revenue coming from Medicare and Medicaid, it has special challenges because the profits are so razor thin from government reimbursements. Also, I'll mention the very complicated factor of the so-called CHOW holds, CHOW, acronym for change of ownership, that applies to a lot of healthcare providers. Specifically, if there is a change in ownership for a company, let's say the company wants to skinny down and shed some of its assets, the Medicare and Medicaid reimbursements will be frozen for a period of time while the government does all of its accountings and sorts through due tos and due froms to make sure the old owner doesn't owe any money, because the old owner is going to go away with respect to getting future money. So I have seen this take months and months, and it really makes it tough when when you've got a well-meaning strategy to skinny down, but then you get a freeze on accounts receivable that you were owed with regard to the transferred assets. Finally, I would say competition in Texas is a bigger factor here than you might think. You read about rural areas where there are not enough hospitals or doctors, but in some urban areas like Houston and Dallas, there's actually much more supply than demand with regard to certain facilities like nursing homes and memory care facilities and those freestanding ERs and urgent care facilities I mentioned earlier that are popping up on every corner. So, competition actually is a significant factor here. I said that was my final point, but actually I have one more point, and that is nonprofits. We obviously have a lot of not-for-profit entities in the healthcare sector, and that can obviously present unique challenges. Maybe you need new capital, a new investor, but the new investor is interested in going to a for-profit status. We've had that happen in several bankruptcies. And I will say for the judge, it's a real challenge because you respect the mission of the non-for-profit entity, but you have to look out for creditors. And so if you have, let's say, an auction and a bidder who presents the high bid and it is a for-profit entity that wants to convert it to for-profit, and then you have a slightly lower bid that will keep it as a nonprofit, sometimes there's a little bit of angst over what to do there. So these are very, very challenging cases. And as I said, I think there are going to be more on the horizon.
Thank you, Judge. John Penn, I'm going to come back to you with a question, but before I do that, I want to make sure that in thinking through my intro of you, I think I may have misstated that and not made it clear that how impressive that you were able to graduate from high school and then in 4.5 years graduate from law school. Having wanted to be a lawyer myself, it probably would have taken me 10 years. So with that, can you give us a quick overview of the bankruptcy code?
Kelly, thanks for that. And yes, we're about to take a very, very quick tour through the high points of the bankruptcy code. And I phrase it that way, saying that roughly half of our participants have some bankruptcy experience. So we're going to just hit the high points. One thing that can come in handy, of course, is you might write this down, that the bankruptcy code is Title 11 of the United States Code. And so anytime someone talks about a bankruptcy code section, you're going to Google 11 USC and the number, and it'll take you to that section. And so that's a quick way to find it without having to ever go to paper. Most people are familiar with two types of bankruptcy, either Chapter 7 or Chapter 11. And the reality is it's a lot more variation that is available. It's not quite Baskin-Robbins with 33 flavors, but we do have a number of flavors to choose from. Chapter 7 is the liquidation chapter. That's the one where all of the companies or the individual's assets are liquidated. One for an individual, it's a non-exempt assets. They're liquidated and then they are distributed by the trustee in accordance with the priorities set out in the bankruptcy code. If you ever want to have some fun, take a look through 11 USC section 507, which is the listing of priorities, because what it really is a listing of lobbyists and to who had the best lobbyists to get those listed. We might roll forward a couple of clicks on the slides. We went backwards somehow. Next one is Chapter 9, and that's for governmental entities at the state level. You're going to see more and more of this with hospitals, because your municipal or your county hospitals are really part of the government. And so whenever they need to restructure their debts, those folks end up in Chapter 9 and not in Chapter 11. It's the C Corps, if you will, that end up in 11. Chapter 11 is the one most folks are familiar with. It's a reorganization. We'll talk a little toward the end about the plan of reorganization as the ultimate goal, but the primary feature of Chapter 11 is the debtor in possession. And what that means is that the management that is most familiar with the company is the management that takes it into and through the bankruptcy. And so it's not like a trustee is automatically appointed to come in as a brand new player to address the issues. The folks that know the business the most are the ones that get to run the process. That's good news and bad news for creditors. The bad news can be that the people that got it into that position are the ones that now have to try to get it out and may not be able to. But nevertheless, it at least starts that way. And if there needs to be a trustee appointed, or sometimes companies will have a chief restructuring officer that one of our panelists has been many times to come in and run the bankruptcy process, that's very helpful. There's a brand new variation on Chapter 11. It's a subchapter 5 is the way it's referred to, because it's a little sliver of Chapter 11 that is a streamlined approach that is much faster and fewer types of filing obligations and reporting requirements between the filing and the plan confirmation. And with the CARES Act, the eligibility for subchapter 5 was actually expanded. When it was enacted last fall, it came in at $2.5 million of debt maximum, at least half of which had to be business related. And the CARES Act increased that to $7.5 million of total debt, with still the at least half being business related. And so your mid-market and more on the mom and pop type companies can use subchapter 5 of Chapter 11 to be a lot more efficient. Chapter 12 is for farmers. You see that more out in West Texas. Chapter 13 is individuals with regular income. That's a wage earner plan, to take a certain amount of payments every month, give it to the trustee to distribute to creditors. And Chapter 15 is if there's a proceeding involving a foreign entity and that proceeding is somewhere else, you can come get relief in the US for that. When a bankruptcy is filed, it's almost like an iron curtain falls. It is a huge line of demarcation at the petition date. As we move forward, what we see is that it divides the types of claims and debts between pre-bankruptcy, the pre-petition debts, and the post-petition debts. The pre-petition debts are the ones that are dealt with in the plan. Post-petition should be paid as you go, 100-cent dollars. Secured creditors, it actually divides that claim based on the value of the collateral. It's a secured claim up to the value of the collateral, and any debt above that becomes an unsecured claim, and the unsecured claims are the ones, if you hear getting 10 cents on the dollar or getting paid itsy bitsy bankruptcy dollars, that's what the unsecured creditors receive. One of the huge aspects of the bankruptcy petition is the automatic stay, and that freezes all collection efforts, all litigation immediately. It's automatic. It's a wide expanding injunction that what I tell my creditor clients is, if you can think of it and you want to do it, you can't. That's about how broad it is. There's also ways to get relief from that automatic stay by going to the court, but at least initially, everything stops so that everything gets focused into the bankruptcy court. Moving on, what we find is leases and contracts get addressed in bankruptcies, and this is where a lot of the retail cases live, is in the leases, because the debtor or the trustee has the ability to either assume or reject the leases and the contracts. If it is assumed, then the lease or contract flows through as if there had never been a bankruptcy, and gets paid 100 cents. Any pre-bankruptcy arrearages or defaults are cured either upon assumption or within a reasonable time thereafter, and they have to pay all of the payments under the contract going forward. You'll also find a number of times where they are modified and then assumed. So you assume the modified agreement. On leases of real estate, for non-residential real estate, there is actually a cap on the amount of the damages. Anyone that has ever done damage analysis for a lease knows that you're going to get sued for the full amount of all rent going forward. But in the bankruptcy, it's a fairly complicated calculation. The best summary of it is the cap is the total amount that is owed in the future, but only the lesser of 15% or 3 years of rent. That's the quick calculation, but definitely read the code or get a professional to help you on the actual calculation. The part that is the most challenging for folks that have never been around a bankruptcy before is explaining to a creditor how they are being sued for cashing a check for money that was rightfully owed to them and paid to them by the debtor pre-bankruptcy. That is a preferential transfer lawsuit. The bankruptcy trustee or the debtor in possession gets to look back in the 90 days before the bankruptcy was filed and see if there are payments that were received in that 90-day time that were payments on account of an antecedent debt that were made in that window at a time when the debtor was insolvent, and there's a presumption of insolvency in the 90 days, and that allows the creditor to receive more than they would have received in a Chapter 7 liquidation. If those elements are met, there are a number of defenses that go along with that that can help, but if it's a preference, the concept is to bring all of those back into the estate. That cash comes back, the debt that was paid is reinstated as a claim, and it is a more equitable type of distribution going forward by bringing the cash and the debt back for the 90-day look-back period. The part that is particularly challenging is what's called fraudulent transfers, which is either a 2-year look-back under the bankruptcy code or a 4-year look-back under the under state law. And there are two different types of fraudulent transfers. There's one that is no fault. It's called a constructive fraudulent transfer. And that is a transfer that is made, excuse me, it's always allergy season in Texas. It's a transfer that was made when the debtor was insolvent or rendered insolvent, excuse me, and which was made for less than reasonably equivalent value. That can come back in and be returned to the estate. There's another kind that is an intentional fraudulent transfer or fraudulent conveyance that is an intent to hinder, delay, or defraud creditors. And when you have one of those, I mean, that's just the black hat kind of a transfer. That's the transfer to your friend, your buddy, your family. It's intended to hurt creditors. When that happens, that comes back in to be equitably redistributed among all of the creditors. And then, as I threatened, we are going to talk a little about Chapter 11 and the overall plan of what happens in a Chapter 11. There's a plan process. The debtor in possession has the first 120 days after the bankruptcy is filed, where it is the only party that can file a plan of reorganization to outline how the existing claims will be paid. They have the exclusive right to do that. That can be extended up to 18 months from the petition date, and it can also be shortened for cause. And so, depending on what the competing interests are, if there's another party that would be able to put a plan forward, you could have a fight over the exclusive right to file a plan. Then once the plan is filed, there are an entire laundry list of requirements that have to be met, some of which are very technical, some of which are fairly common sense. Getting past the technical and talking about the way that certain claims are addressed, the administrative claims, those that were incurred during the bankruptcy case, have to be paid in full, in cash, on the effective date of the plan, unless the creditor agrees to a different treatment. Priority claims have to be paid in full. That goes back to the folks with the good lobbyists under 11 U.S.C. 507. Then you get into the secured claims, the ones with perfected liens, and those have to be paid in a manner in which the present value of the payments is not less than the secured creditor would have received in a liquidation. Also, it has to be at least the value of the collateral as of that time. And so there's a valuation process that goes. Judge gets to hear evidence if it's contested to decide what the value is going to be. And then it's a matter of doing the math, determining the appropriate discount rate along with the appropriate interest rate on the go-forward debt to come up with the present value. Unsecured creditors have what's called the best interest of creditors test. And that is they have to receive not less than they would have received in a Chapter 7 liquidation. So you do a liquidation analysis and you compare it. Note that it says not less than in a liquidation. 0 in a liquidation can be 0 in a reorganization. It doesn't have to be 1 cent. If they were never going to get any payments in a liquidation, don't expect to get any payments in a reorganization. And then finally, there's the absolute priority rule, which if a creditor class rejects the plan, because voting on the plan is done class by class, usually each secured creditor is in their own class, unsecureds are in their class, and classes, the way you vote, it's not by mail necessarily, but what you do is you add up both the votes and the amounts of the claim, because for a class to accept, it has to be at least 1/2 in number of creditors in that class that vote, and at least 2/3 in the dollar amount of those claims. So if you don't meet that threshold and you do have at least one impaired class that has accepted the plan, then the absolute priority rule gets triggered to confirm the plan over that rejection. Quite simply, for secured creditors, it's a valuation test. And for unsecured creditors, you look at the strict priorities that you would have in a regular outside of bankruptcy liquidation between debt, subordinated debt, equity, those are, ownership interests, those kind. And as long as the party, if the rejecting class, if there's no one junior to that class that's receiving anything under the plan, then it can be confirmed over their rejection. That was a forced march through the bankruptcy code. Kelly?
Thanks, John. One last question for a lot of our audience members. Bankruptcy is an unfamiliar subject and somewhat frightening event or process to contemplate. What would be your main takeaway for our audience? And I want to address something real quick that you said, read the bankruptcy code. I hope you'll highlight that if you are not a bankruptcy judge, a bankruptcy attorney, or a highly qualified consultant like John Tittle, don't try to swim the code by yourself.
I agree with that, but it's also good to read it so you can see how convoluted it is. Because it has been said, and it is true, that those who enjoy law and sausage should never see either being made. The bankruptcy code is a congressional construct that came in as a renewal in 1978. It had an overhaul in 2005. Congress did it. That doesn't mean it has to make logical sense. It is the code. Once you understand that, and that it's designed to try to realign interest and redistribute assets for creditors, the rest of it seems to make sense.
Awesome. Did I impede on your main takeaway?
Nope, that's it.
Thank you. I believe it's time for a CPE question.
Thank you so much, Kelly. I'm launching that poll, and I've had a couple of comments that the poll is not up long enough, so I'm going to sort of chat through this one. Your third poll is, do you have a better understanding of the bankruptcy code? It seems that we have a lot of folks answering that question right now, but again, I'll give you a couple of extra seconds to get through that. Okay, it looks like we've got almost all the folks answering that question, so I'm going to end that poll and show you those results. We've done a great job.
Great job.
Very good, John.
Very good. We have had a good overview of the current situation. John Tittle, if companies are seeing financial issues, what do they need to consider at this point in time?
Thank you, Kelly. For some of you, financial issues, or even looming on the horizon, could be new to you and your company. So we're going to turn our attention to out-of-court workouts first. So let me answer your question about financial issues this way. First, if you're in a company, don't take a wait-and-see posture. You know, there's a natural tendency to wait. But we can't wait for another round of PPP. You know, are we going to have signs of sustained recovery? And there could be other reasons, you know, that you're going to say, well, let's just wait till next quarter. You can't wait and see. You need to, time is of the essence. What actions are required right now? You know, and you see things on the horizon, you need to be prepared. You know, like our resident, you know, Eagle Scout John Penn, you know, their motto is be prepared, right? So, you know, clearly, you know, we need to be prepared and start addressing things. Above all, that you'll find that are two things that are in short supply in a restructuring: time and money. You'll need time for restructuring efforts to turn into results, and it takes money to get you through the turnaround. Let me assure you from personal experience, you've heard that I've been chief restructuring officer a few times. And I've also served as CROs, CEO of some companies in bankruptcy. If you run out of money or availability, liquidity, it's over. And that's what we call a liquidation. I'll give you a perfect example. Had a company that we were in a situation where we needed funding to finish the turnaround, but yet the funders like Ross needed to see evidence of a turnaround for a sustained period of time, and Ross, I'm sure, will address that. And the problem is, I couldn't show the turnaround without the money, but I couldn't get the money without the turnaround. And so time and money are critical, and doing things early is very important. I would also add, and this is going to sound self-serving, but the judge can chime in here in a moment. And that is that you need to consult an attorney and a restructuring advisor early in the process if you see problems looming. The earlier you bring folks in like us, and again, this is not an advertisement for us per se, but people like us, all things being equal, the sooner you do it, the direst of measures, whether that be a bankruptcy, an eventual liquidation, or let's say that you file for bankruptcy or whatever, and you lose control of the company through the appointment of a trustee, again, that's your worst nightmare, right? This can be avoided if we're brought in early. Remember, and what we're also going to talk about is the out-of-court restructuring as a alternative to filing bankruptcy. Again, we've heard a lot about it, but also that we'll discuss options of what you do, again, if that do not involve bankruptcy beyond the out-of-court workout. John mentioned the term insolvency, and as a financial expert who's testified regarding whether a company's solvent or not, let me explain for financial people, for some of you that don't know what insolvency is. And that's when and I'm sorry, I'm not exactly going by the slide, so you can go back and forth between my two slides, I apologize. When you can't pay your bills timely, or you have excessive debt or both, you could be really what's called in the zone of insolvency. So again, insolvency is a legal term, as John Penn indicated, that's defined by the bankruptcy code. And you can think of it in three different ways. One is where the fair value of your assets, less your liabilities, where your liabilities exceed your assets at fair value. The second thing is if you can't pay your debts as they become due. So for example, you see a company in their balance sheet, basically where their current assets is much less than their current liabilities. Clearly that could be a problem. So if you can't pay your debts as they become due, or if you have insufficient capital to basically conduct the business you're in. So you're in this zone, right, where you're insolvent from one of these measures. The thing to keep in mind as an officer or director of a company is at that point, your duties as an officer and director shift from the shareholders to the creditors. In essence, you're really operating the company for the creditors, and it changes a lot of things. So in that zone, you may need your restructuring person you've brought in for advice to actually become a member of management, to be a chief restructuring officer. And that person is getting in basically in the boat with y'all, and he or she is gonna take all the arrows that y'all are taking, including being sued if necessary in a case, which has happened to me right now. Because it's a legal theory that one of the creditors wants to pursue. Anyway, so a CRO is a person who has management duties and responsibilities. I would have the same fiduciary duties as any officer and director would have. The thing
John, this is Judge Jernigan. Can I add a very important footnote?
Please do, because I was in turn to you about that and about the independent board member.
Well, that's exactly where I was going to go. You, of course, mentioned it's critical that companies not wait too late, not to wait until they have no liquidity. And you mentioned the importance of getting professionals on the scene, such as a CRO, when they get into the zone of insolvency. Just to add, again, a footnote to that, it's very important to a bankruptcy judge to see if you have independent members on the company's board of directors. Maybe you never did for the life of the company, but once you get into the zone of insolvency, it's very important for you to get one or two independent members, members who are not equity owners. As John Tittle so well described, when the company gets into the zone of insolvency, which is a fuzzy concept, there are heightened duties of due care and loyalty, for that matter. The fiduciary duties of due care and loyalty are deemed to run to the creditors once you're in that zone of insolvency. So if all of your board members are shareholders, obviously the judge is going to be concerned about the conflicts. Did you really have your board in an unfettered way make decisions that were for, first and foremost, the benefit of the creditors? So it's a really good way to end up having a trustee get appointed in your Chapter 11 and take over control of your company if you don't have independence to some degree on your board. John, I hope I didn't step on what you were going to say, perhaps.
Perfect. No, Judge, that's perfect. And again, it's good for you, for our audience, to hear from a judge who, again, you're basically calling the balls and strikes in essence. So it's important to hear from you and what you have to say. So if continuing then with the issue again of the, where, if you happen to be in the zone of insolvency and the hiring of professionals, what we would help you do in conjunction with the judge, if necessary, if you have to go into Chapter 11, is we in essence help the company or come to a soft landing. Now, and I tell people, and I tell CFOs who say, look at me, and they say, well, Tittle, I can do what you do, and all I can tell them is, number one, I bring some credibility that, again, things may be strained between your lenders and you, or your company and your creditors. And also I've seen the movie before many times. And so there's some insight that I can bring as well. I'm not saying that I can replace you. I can do things better. I'm going to come with a new perspective, and I've seen the movie before, and sometimes it doesn't end well. Same way with, again, I bring some credibility because I'm a third party, just like Judge Jernigan mentioned about an independent party. When you have a financial issue, whether it be a payment or covenant default, and I know someone asked a question about John's slide, or actually Ross's slide, about covenant light loans. I mean, that's the phenomenon. It was the fact that commercial lenders were looking to be competitive, or lenders in general, and also alternative lenders. They've designed this product called a covenant light. So that's what gives rise to a lot of extent to these loans that don't have any covenants. I think of asset-based loans being different, but that's again a topic for another day. But in general, let's say that you have a payment default. You're going to find yourself meeting with the bank workout officer or with a bondholder, creditor representative. At that point, I can assure you that your relationship with that creditor has changed. It will not be business as usual. And so you're used to dealing with, your very personable relationship officer at your bank. That person probably will go radio silent. What you're going to find is the need for information is heightened, and every piece of data and information that you give is going to be under the microscope. There will be very little margin for error. And you may know the creditor's intentions and you may not. Normally at this point, you're going to be asked to deliver a 13-week rolling cash flow forecast. And I know some of you are going to go, man, I've never forecasted cash on a weekly basis. What's that like? And again, you have to be extremely cautious because if the budget you prepare, I mean, excuse me, the 13-week rolling forecast that you prepare is going to be your budget. And while again, it'll be important to have a restructuring attorney there that can negotiate wiggle room on the covenants, but the variances from that you're allowed. I'm running into time. Okay, so and you're going to then you're obviously going to be measured against that. You're going to need to scrutinize every line item to preserve cash. The next thing is and then along with that, what are we going to do to raise cash? You need to look at everything from selling the corporate jet, from monetizing non-operating or excess assets, identifying and selling non-core businesses. Basically, there can be no sacred cows. Everything must be on the table. Frankly, I have no problem, if I'm in that position as a CRO, I have no problem with telling Caesar that he has no clothes. And let me just say, I know the natural instinct is to, well, we'll just borrow more money or we'll take on more debt. Let me assure you that debt is not your friend. Beyond forbearance agreement, I know someone's asked about what do we do with customers? I believe that was Joe had asked, what do we do with customers? Well, so I want to talk briefly about customers and vendors because it's actually interesting dynamic. I know that
John,
yes.
Can we leave that question until the end?
Yes, but I was already going to talk about customer issues anyway. And that is that, you normally rank customers by A, B, C, D, a lot of companies do, depending on the volume of the client, the volume of the customer, the margin, et cetera. But beyond those rankings for customers, what you may want to consider are those, if they're having trouble, could you be their critical vendor? Which could be an interesting dynamic because normally if people are having trouble, you want to go, oh, I got to manage that. I got to cut them off. Well, and I realize this requires some communication and transparency on the part of your customer that they're willing to sort of open kimono but if they're willing, it could be an interesting opportunity for actually you have a longer term relationship with this company by being their critical vendor if they do have to go into a Chapter 11. So that's another strategy in terms of instead of cutting them off, meet with them and ask them questions and again, see if you can get some transparency. Sometimes you can't. And if they're going to be opaque, then probably won't work because what they will do is once you've seen is that they'll run up, they'll run up a bunch of purchases and then they'll fire. So even for suppliers, you need to prioritize your your payments. And so the ones again that you believe will be your critical vendors, I would actually pay them over if you're C and D ranked suppliers that you don't necessarily need. I would tend to extend them more than I would the ones that are critical. Because you need to give yourself some dry powder with those vendors. For other creditors, particularly like junior capital providers, so like second lien holders, et cetera, you really need to identify the player that's what's called the fulcrum security. And that's the creditor or bondholder, whatever, that was either in the money or partially in the money in the capital stack. So in essence, if there's proceeds and there's a sale and there's a waterfall for the creditors, this is the part of the capital stack that gets a recovery, and then nothing up below it, whether it's unsecured debt of various things, whether it's bondholder or trade, they're not going to get anything. And so it's important to identify who that fulcrum security is and begin to really have discussions with them. And with that, I'm going to have our resident investor, distressed investor lender, Ross, explain why.
Before we go there, can we do one CPE question?
Sure.
Yes.
Thank you very much. I put the polling question up on your screen. The question is, in a restructuring, what are in short supply? Your choices are time and money, time and talent, talent and money, none of the above. I'll give you a few seconds to answer that question. Don't forget to hit submit. Okay, I'm going to launch those results. And there you have your results. Seems 81% seem time and money are the short supply.
Thank you. Ross, back to John's comment. When you're investing your or other people's money, what opportunities do bankruptcy and distressed company providers have?
It's a really good question, Kelly. I think there's a lot of misinformation about bankruptcy, interestingly, and that's actually played in my favor. I started out in the late 80s and early 90s working with some of the folks who helped build the restructuring advisory industry. They were former bankruptcy attorneys, and they had a big notion that there would be a lot of opportunities to restructure the high yield debt that became a pretty common part of the 1980s economy. Folks probably remember that. And that basically precipitated the first wave of restructurings in kind of the modern age of restructurings. And so I think people sort of fortunately are naive about bankruptcy and restructuring, and they get a perception that it's a dangerous area that you want to stay away from. And there's a lot of truth to that, right? I mean, in a lot of ways, I hope that most people, this is the most you ever hear about bankruptcy, right? I don't think Your Honor wants people to necessarily visit her court unless they absolutely have to. I would say in some respects, it's a little bit like going to the hospital. I think we would all recommend that we try to take care of ourselves and avoid the hospital. But in the end, there are those situations where you do have to go get some intensive treatment or intensive care. But with that said, bankruptcy actually is one of the uniquely safe places to actually invest. Let me kind of explain why. You know, when you're dealing with an auction, an investment bank might run an auction to sell an asset or to sell a company. In many cases, there really are no predefined rules. In the end, you're trusting a process led by folks. But in a bankruptcy process, there actually are not only defined rules and the rule of law, but you have advisors that are subject to that rule of law, and you have a referee, if you will, in the form of the judge, who's going to be able to rule on these matters. There's really only two times in the life of a company that you might argue it is clean, per se. The first time a company is clean is the day it is formed. It has no liabilities, it has no pre-existing conditions, and it has no issues to resolve. It just has a world of opportunity. The second time that company's clean, frankly, is the day it emerges with a court order from the bankruptcy process as a newco, if you will. And so there's actually quite a bit of safety and security in bankruptcy processes. It's actually a great place to invest. Because in many ways, it causes people to come to terms with the fact that they've got to make some changes that frankly probably should have been made before. And, you know, everybody kind of needs a nudge every now and then to make a big change in their life and in their company. And I think bankruptcy and the stress of those situations can sometimes lead to a lot of positive things. And that's been my experience with bankruptcy. So there's tremendous opportunities to invest, opportunities to help, opportunities to do some good by taking companies that deserve a second chance and giving them that capital and that know-how, giving people a second chance and the know-how to succeed. Because you often find that the answers are within these companies and the people within the companies. So it's a world of opportunities, Kelly.
And Ross, in your experience, do you find that whenever a company is in a bankruptcy, the company and everything it owns are in play?
Yes, it's pretty exciting, you know, from a lot of perspectives. And I guess to echo some of the points made by the distinguished panel here, you know, in an ideal world, you're taking these actions well before any filing. You know, you've got an opportunity to go through and figure out what's your core business, what's your non-core. You've got an opportunity to divest some non-core assets and raise some cash and refocus on that core. You've got an opportunity to trim down those expenses before you get in trouble with the creditors. Go to those creditors ahead of time and try to buy time, try to buy a partnership, try to create some space for yourself to resolve these issues ahead of a filing. You know, get to know folks who can help you sell assets, restructure assets well before you might run into that trouble. You know, but, you know, as we've seen, you know, and many times there's companies that are good companies, but they're subsidiaries of troubled parents. So, you know, again, you have to be, that's another interesting point about bankruptcy. People think, oh, the company's in bankruptcy, it must be a bad company. Not true at all. There's fabulous companies in bankruptcy. I've bought, you know, a number of companies and assets out of bankruptcy. Great companies, but they had a troubled parent situation, a parent whose core business was struggling, and the subsidiaries are captive to that parent, and they kind of get their chance to break free, if you will, and get a new lease on life with that independence and some upgrades there. But if you end up in that Chapter 11 process, which is some of the slides here, then you know, like we talked about, it's going to be a pretty rapid process. You are going to get a period of exclusivity to form and recommend your own plan, but you're going to have to fund that time. And the ways to do that are basically, you know, three, right? You can have cash on hand necessary to fund the bankruptcy. Most people don't do that. I've actually done it. So when I had a company that I had to go through a bankruptcy process, it was in fact an energy company, you know, made $30 million of EBITDA 1 year. The next year, you know, the EBITDA was gone because of the ups and downs of the oil market. We actually did the work of monetizing assets, creating enough cash to do what's called a cash collateralized plan. You really have to know your business. You really have to know your customers. You really have to understand every element of your cash flows to do that, but it can be done. And that honestly is the best way to finance your plan, if possible, is with cash, because you're in charge, you're in control. People don't have leverage over you. You have the leverage over the process because you're in control of your cash. The other ways to finance it are through a DIP financing. DIP is a debtor in possession financing. Again, a great opportunity for investors because, as John mentioned, a DIP financing source comes in as a super priority claim, if you will, or status, I guess is the right way to say it, which means that they will be repaid before anyone else. And the cash literally and the collateral necessary to repay them is segregated. It is theirs, they're first. You know, and they're going to be protected. And so it's actually a very safe way to invest. And then to the point that I think Joe made earlier, asking how do you handle customers that are going to bankruptcy? One of the, I think, real interesting riddles that people don't understand is if you work with a customer before they go bankrupt to pay down that receivable before they go bankrupt, it actually is a great opportunity to develop a relationship with them, to become a critical vendor and do post-petition work with them. Because just like that DIP lender is going to have a priority position in the capital stack and get paid before anyone else, so does a post-petition critical vendor get paid ahead of everyone else. And so it actually can be a great opportunity to have an amazing relationship with a good company where you're going to get paid with 100% certainty. And when they exit, because most of the companies exit and go on with their business in a restructured fashion, they're going to be a long-term partner that never forgets the fact that you helped them through that difficult time. And so there are a lot of opportunities within that. Obviously, there's a capital stack of opportunities in these types of situations. So you could be investing in that debtor in possession financing. You could also be providing the exit financing, which I guess is the next slide that we talk about. There's a lot of ways to exit these particular situations. I'll just talk about a few, and each one of them I think represents multiple paths that can be taken. So one most common way that I think people think about exiting a bankruptcy process is through a Section 363 sale process. So this is where the bankruptcy code provides for a market-like solution in the sale of the company, despite the fact it's operating in bankruptcy. So you'll have an investment bank. The investment bank will take the book on the company and market it to the as many folks as they can, so that it's a fulsome process of marketing the asset. And then generally you will find one particular interested acquirer that really gets ahead of the process, really puts a good sort of negotiated offer on the table, and they become something called the stalking horse bidder. The stalking horse bidder is really the contract to beat in the auction to purchase the assets. And those 363 auctions honestly are a lot of fun. They're very exciting to go through. And if you're the stalking horse, again, one of the reasons to learn a little bit about the bankruptcy code, you actually get protections in your bidding. And so this is one of the fun things in my life, is being the stalking horse bidder and having a breakup fee if I lose the deal, and having the reimbursement for the costs that I expended to be in that position. Now, the courts have certainly curtailed, capped, and narrowed the amount of reimbursement that's possible and practical, but generally it's around 3%. That could be the amount of a breakup fee or a reimbursement for the stalking horse bidder. So you've got an incentive to go in there and make a run at the company. That's going to benefit you because you've got a backstop you don't get in a typical deal. It's going to benefit the company because, again, this is going to give bidders the floor contract, the floor price, and then you're going to have your honor approve bidding procedures, which then allow for the bidding to happen. And that's pretty exciting. And you'll have incremental bids that have to occur. And it's like an old-fashioned auction to purchase these assets. And everybody likes an auction. And it does tend to stimulate outcomes that are a little bit not what people forecasted. And there's a lot of situations where people, bankruptcy has actually turned out to be a good thing in terms of the total outcome for different investors. So that's one way, the most common way, but the way that you don't read about in the newspaper as often maybe is the plan of reorganization, where they work it out, where the management team works it out with their creditors and their equity holders and in a restructured fashion proceeds. Another is a plan of liquidation. That's where effectively a lot of assets are sold, and you can actually be the purchaser of those assets without an auction, because it really takes an agreement amongst the equity holders and the secured creditors in order to approve a plan of reorganization that allows an investor to participate. And I've bought assets via plan of reorganization. I did a deal called Key Plastics in 2001. It was a great deal, and we acquired those assets via plan of reorganization. Another deal, Allegiance Crane, I bought via plan of liquidation. Visionese Lens, polycarbonate lens maker, I bought as the stalking horse bidder through a 363. And so all those are great ways to provide exit financing. And in any of those scenarios, you're going to be lining up probably an asset-based loan of some sort, using your collateral to finance your exit. You're probably going to be looking for a stretch piece of debt, which is a mezzanine or subordinated loan. And then you're probably going to be looking to either convert an existing lender into an equity position or bring in new equity. And the rates of return, honestly, once you get to mezzanine, you're looking at double digits all in. And for the equity holders, they're looking to get greater than 20% rates of return for the risk they're taking. And then those super priority holders, the priority administrative claims, they tend to be in the mid to high single digit range for their return profile. I know we're running out of time, and it's a never ending set of permutations in bankruptcy, Kelly, but that's a little bit of flavor for how you might finance it and how you might finance the exit.
Well, and I hope if people are want to stay at the end of the presentation and ask these questions, that you guys can stay and help us. But I do have a quick question for you that I think that they might be interested in. But not that one, we just went through that one. But what is the best way for our audience to gain access to a capital provider such as yourself and your funds?
You know, I think it's a pretty straightforward process. You know, I think you basically, depending on what stage you're in, I would recommend getting to know folks sooner rather than later. So I constantly am bothering folks like the Johns here. I don't get as many opportunities to bother the judges, but when I do, it really pays off. And so I recommend that for everybody else, right? Don't wait until the Great Recession or the COVID pandemic or the next monetary crisis or the next currency crisis in South America to get to know John Tittle, John Penn, Your Honor, Kelly, and this team. Get to know them now. You know, have lunch, come to some of these webinars, go meet with them, ask them questions when there's no danger, right? The time to visit the doctor is when you're healthy, right? That's the time to go. And so get to know them now. You know, I've got an open door. You can send me anything, ask me anything. I'll just tell you the straightforward answer. And then you get a sense for folks that you can count on to kind of give you straightforward advice. Because the truth is there's good deals to be made where people don't have to exploit a situation to have a really good opportunity across all stakeholders. And all it takes is experience, good judgment, and honestly, a good heart where you really want to do the right thing. There's good opportunities within here. So I'd get to know those folks now. Don't wait.
Thanks, Ross. I think we have another CPE question.
Thank you very much. Here's your 5th polling question, folks. The question is, have you or would you consider a distressed investor? The choices are yes or no. I'll give you a few more seconds to answer that. Don't forget to hit submit. I think a lot of people are struggling with this question. Okay, if everybody's ready, I'll give you another second. Okay, I'm going to end that poll and share those results. And there you have it. 57% would say yes.
Awesome. Good job, Ross. Judge, last question is for you. What is different now in bankruptcy?
All right. Well, I'll be quick. Starting with the obvious, we have many pandemic-related only bankruptcy cases. In other words, no financial problems until March of 2020. And as John Penn said earlier, businesses were not only struck by lightning, they were hit with an atom bomb. So that is something very different. Second, I would say more than ever, we have different types of lenders, a different array of lenders. No more do we have majority traditional banks as our lenders. We have private equity, we have hedge funds, not surprisingly, we have some PPP loans. So this is a very different dynamic. Obviously, some lenders have very different motivations than others. Maybe, you know, the private equity fund all along was hoping to loan to own. We have hedge funds who perhaps bought their debt from a traditional lender at a steep discount, and so they're motivated to make a profit as fast as possible. So again, it's affected, I think, the dynamics of the negotiation that goes on during the bankruptcy. Third, Ross talked extensively about the post-petition lender. You know, our terminology is the DIP lender, the debtor in possession post-bankruptcy loan. We're seeing more and more different players get into that role. Sometimes we're having vendors get together and make a post-petition loan where we can't get a more traditional lender to step in. We've had landlords stepping in when maybe one of their shopping center tenants files bankruptcy, and second lien lenders and others. Next, speaking of landlords, suddenly the dynamics are very different in bankruptcy between the tenants who file bankruptcy and the landlords. I would say the tenants have more leverage these days than they have historically. Part of it is just the reality of the marketplace, right? Because you have more and more landlords who have tenants closing up, moving out, and non-paying tenants who want to stay in. As John Penn mentioned earlier, the bankruptcy code is very much a product of lobbying interest, and the landlords have had powerful tools put in there, and well, so have tenants. But I would say now more and more we have creative lawyers finding workarounds the bankruptcy code. Just a very quick example would be that even though you get a bankruptcy breathing spell with regard to your landlords, and you get time to decide, do I want to assume or reject? You get time to cure a pre-bankruptcy arrearage. You're supposed to resume normal post-bankruptcy rent payments to the landlord, and the code builds in at most 60 days of a breathing spell before you might have to do that. Again, too long to explain on this call, but let's just say we have some creative lawyers now who are coaxing landlords to change that result a little bit. I guess the last thing I'll mention is that we have some totally out in left field strategies being pursued in these strange times. And I would point to the Hertz rental car bankruptcy case, which many people may have read about. The company, instead of doing a traditional debtor in possession loan after they filed bankruptcy, they asked bankruptcy court permission to do a public offering of new stock because we had some irrational exuberance in the market. Their stock was trading out the roof for some inexplicable reason. The bankruptcy judge, to my shock, approved that concept, and the company made about $29 million before the SEC stepped in and said, whoa, you are not going to do this. So it's just an environment where we are seeing some atypical strategies pursued. I said that was my last point. I'll mention that key employee retention bonuses and key employee incentive bonuses, they were kind of dead in the world of bankruptcy for several years because of changes to the bankruptcy code Congress made in 2005. We're seeing some workarounds there. Among other things, we're seeing people try performance bonuses before the bankruptcy court instead of state bonuses, because the bankruptcy code makes those a little bit easier for the judge to consider. But we see people implementing those before they file bankruptcy, sometimes to avoid the risk of creditors coming unglued and a bankruptcy judge saying no. So that's kind of a recent trend. All right, I'll stop there.
Nancy, our last polling question.
Thank you. Give me just a second. There it is. Here's your last polling question. It's number 6. Are you considering restructuring or bankruptcy at this time? Yes, no, or not decided. Take a few moments and answer that question. Okay. I think everybody's voted. That seemed to be an easy one, so I'll end that poll and share those results. I think that's good news for the folks on our panel.
You may not want bankruptcy, but it may be in your future to have to deal with someone else's.
That's true. I want to thank everyone for being on today and listening to this amazing panel. I think you'll agree with me. They are not only knowledgeable, but entertaining. Nancy, I'll turn it back to you.
Actually, Kelly, I wanted to thank you. Kelly, I wanted to thank you for doing such a great job as moderator. And it was a great program. Thank you to all the panelists, John Penn, John Tittle, Judge Jernigan, and Ross Gatlin. Thank you guys very much for such a great program there. I was amazed at how much passion and energy you guys brought to the subject. And I think we got a lot of great information and good contacts. And that last question was a good question to end on. I was kind of hoping that everybody was here for the information and CPE and not because they needed bankruptcy. So, but it's good to know the people. It's good to know how it works. Real quick, before she finishes up too, I just wanted to remind everybody we do have a couple of other webinars coming up. On August 27th, the University of Dallas, one of our partners, is doing a program on lessons in courage and sound judgment from the rise and fall of Theranos, which is obviously about Theranos, the blood testing company, Elizabeth Holmes. I think it's just a fascinating topic and one I've been trying to get, I guess, someone to do for a while now. Also on August 31st, the University of North Texas is doing, the topic is COVID-19 related impacts to financial markets. And then last, I will tell you that, remind you that on September 14th, we have our first FEI chapter meeting of the year. So with that, I'll turn it over to Nancy. Thank you, guys.
Thank you very much, everyone, for attending and participating today in our webcast. We did have a few questions come through the platform. We are out of time for those questions, but I will get those questions to the panelists and they can respond to you via email, and we do thank you. Today, we will let you know that your CPE certificates will be delivered via email notification to let you know when they are available on the FEI website. Should you have any questions, please feel free to ask me, nancy.ellers@feidallas.org. And now this ends our webcast. We do appreciate your participation and we wish you a great afternoon. Thanks so much.
Thank you.
Thanks, everyone.
Thanks, everyone.
Have a great weekend.
Thank you.
Does that
Bye.
mean you're gone?
You guys did a great job. I really appreciate y'all doing it.